Hey folks, hope you all are doing well. I'm Karan Bandal from Econosite, your weekly wrap on economic news from India and around the world. So let's get started. Car sales hit all-time record in September on strong demand. India is seeing a strong consumer sentiment for new purchases despite rising interest rates and inflationary pressures. Companies such as Maruti Suzuki, Hyundai, Toyota, Tata Motors, and Skoda pumped up production and sent record numbers to dealerships. Maruti Suzuki reported wholesale passenger vehicle deliveries of 1,48,000 units in September this year, 135% higher than what it was last September. Hyundai, the second biggest car maker, clocked a growth of 50% and dispatched 49,700 units this September. Tata Motors witnessed a growth of 85% to register 47,654 vehicle deliveries, and Mahindra sold 34,508 units, 168% higher than what they did last September. But keep in mind, because of the semiconductor shortage last year, the production numbers were muted. So, this growth that we are seeing this month, this year, may be a little overstated, but still impressive numbers. Look at the market share of top 7 automakers in India for the month of September 2022. Maruti Suzuki maintains its leadership position. Tata Motors and Mahindra have slowly been increasing their individual market shares as well. All the car companies are expecting this momentum to continue during the upcoming festive season of Diwali, where sales numbers may improve even more. What does that mean? When things are slowing down globally, India is in a unique position where inflation is relatively low and consumer demand is holding up. And since consumption makes up 60% of India's economy, this indicates that Indian growth prospects remain strong in the near term at least. Let's look at supply side story next. September PMI shows manufacturing grows for 15th month in a row. Output looks set to expand further. Before we get into the story, let us understand what is PMI first. PMI stands for Purchasing Managers Index. PMI measures month over month change in economic activity within the manufacturing sector. Manufacturing PMI is observed very closely as it is a reliable leading indicator of economic health. So, how do we actually arrive at a particular PMI value? PMI is calculated based on a monthly survey of supply chain managers across various industries. This survey is conducted around 5 major areas: new orders, inventory levels, production, supplier deliveries, and employment. Without going into more details and calculations, keep in mind this about PMI. A PMI above 50 represents an expansion when compared with the previous month. This is what we like to see. PMI reading at 50 indicates no change. A PMI under 50 represents a contraction. If you are interested in learning more about PMI, I will include a link in the description below and you can check that out later. Back to the story. The S&P Global India Manufacturing PMI posted 55.1 for September 2022, higher than 50 for 15th month in a row. And now you all know what PMI above 50 mean. Amid global headwinds like Russia-Ukraine war-driven high energy prices, recession fears, policy shocks like US Fed increasing the rates at the fastest pace ever, manufacturing sector in India remains in good health. In other words, India's manufacturing capacity has been increasing for past 15 months in a row. To back it up, look at this. Apple iPhone exports from India doubling in Boon to Prime Minister Modi's plan. iPhone exports from India crossed $1 billion in the first 5 months since April 2022. At current rate, outbound shipments of India made iPhones, mainly to Europe and Middle East, are set to reach $2.5 billion in the 12 months through March 2023. That's almost double the $1.3 billion worth of iPhones India exported in the year ending in March 2022. So, development such as these, I am sure, are contributing to strong manufacturing PMI readings month over month. Moving on, Reuters here talks about mergers and acquisitions activity. Dealmakers eye China divestments, rise of India and Southeast Asia as M&A pipeline shrinks, M&A, mergers and acquisitions. Deal makers in Asia are seeing a retreat of multinational companies operating in China and rise in acquisitions in India and Southeast Asia. And folks, Southeast Asia uh, consists of 11 countries that reach from eastern India to China, Myanmar or Burma, Thailand, Laos, Cambodia, and Vietnam. These 5 countries are grouped as mainland countries since they are an actual extension of the Asian continent, and the remaining are maritime or island countries, including Malaysia, Singapore, Indonesia, the Philippines, Brunei, and the new nation of East Timor, which was formerly part of Indonesia. Back to the Reuters report, deal making has become challenging due to global headwinds like Russia Ukraine war, central banks raising interest rates, and several major currencies being on shaky ground, tanking against the US dollar. Overall, M&A value was down 35% worldwide and 36% for the deals in Asian region. Per bankers and lawyers, China's outlook is further clouded by country's strict COVID-19 policies, as well as uncertainties over its policy direction ahead of next month's leadership reshuffle by the ruling Communist Party. M&A transaction values involving China plunged by 35% year on year to $266 billion in the first 9 months of the year. This is the lowest level since 2013. Still, China remains Asia's largest deals market. Bankers and investors said that private equity firms that drive majority of the M&A activity in the region, with over $500 billion of unspent capital, have pivoted from China to look at other Asian markets, particularly India and Southeast Asia. India M&A shot up 55% by end of September 2022. India is the only country in the region where M&A value has gone up in 2022 so far, and the momentum may continue. As we saw with vehicle sales, the consumer demand remains strong in India. Manufacturing PMI is in expansion territory, and multinational companies are looking to diversify their supply chains, looking for alternatives to China. India has been a beneficiary of such current global trends. Of course, supported by government schemes like PLI, production linked incentives, improving ease of doing business, and investment in infrastructure, as we talked about in the previous videos. This interest in the India story is also visible in equity investments. We have to look at MSCI indexes to understand this. Let's talk about MSCI. MSCI is an acronym for Morgan Stanley Capital International. It is an investment research firm, and MSCI is perhaps best known for its benchmark indexes. In case of India, MSCI India Index is designed by MSCI to measure the performance of the large and mid-cap segments of India market. It has 109 constituents and covers approximately 85% of the India equity universe. If you want to understand how the Indian equity market is performing, we look at Sensex and Nifty, right? But as a foreign investor, you look at MSCI India Index and how it is moving with time, and you understand how the Indian equity market is doing. Same is the case for MSCI China Index and for other emerging economies. The story states that China's $5 trillion rout causes historic gap with Indian stocks. The MSCI India index rallied almost 10% in the quarter that ended in September 2022, whereas MSCI China index dropped 23%. So the absolute difference is 33%. India plus 23, China minus 10. You can see here that India MSCI index has outperformed China index more frequently and with higher magnitudes over the last 22 years. The 33-point outperformance by India gauge in the last quarter is the biggest since March 2000. Here you can see how MSCI India index is moving compared with MSCI Emerging Markets Index, particularly post pandemic. Months of outperformance has made Indian stock the most expensive in Asia in terms of an earnings based valuation. The measure used here is PE ratio, that is price to earnings ratio. PE ratio for Indian stocks is slightly above 20 right now, and that for the Chinese stocks around 10. Higher the PE, more expensive the stock. Economists surveyed by Bloomberg expect the Indian economy to grow by 7% this fiscal, almost twice of the growth that China has experienced in 2022. So, in the current environment where economies around the world are either slowing down or are in a recession, India remains the only major country that is projected to grow at a decent clip. Investors are willing to pay a premium to share in that growth, which is evident from the India MSCI India index trajectory. All in all, I see global capital moving into India. Consumer demand, which makes up majority portion of India's economy, remaining strong. This dual engine of growth should allow India to ride out the upcoming global economic storm. Hope you found this week's wrap interesting. I will speak with you again next week. Until then, take care.